Hello, thank you for tuning in to OJM's 2015 Market Outlook. My name is Andrew Taylor, and I'll be presenting today. Our goal is to get through the presentation in about 12 to 13 minutes. So we'd like to start with our standard disclosure slide. I think the key point here is that the information presented today reflects our general viewpoint and is certainly not meant to act as a substitute for personal investment advice. Now, many of you listening are familiar that OJM's written numerous books for physicians, business owners, entrepreneurs, etc. If you are interested in a complimentary copy of one of our books, we will provide instructions on how you can make that request at the end of the presentation. So the agenda for today, brief look back at 2014. We'll look at equities, oil, and central banks. Global investing, should it continue to be a part of your portfolio? And finally, the reason that most of you tuned in today, our viewpoint on asset classes and portfolio position as we move into the new year. So 2014 resembled 2013 in several ways, and I guess most notably the divergence of returns in asset classes. If you look at the numbers on the right, you'll see that U.S. large cap stocks significantly outperformed all other asset classes. The numbers there are specific to the S&P 500. Under U.S. large cap, small cap did 5. Most of your international markets actually had negative returns, with EFA and emerging markets both in negative territory. One large reason for that, it was the strength of the U.S. dollar actually had a very significant impact in terms of the overall results on the international side. And then, contrary to expectations, despite most economists calling for rising rates now for 3 consecutive years, once again in 2014 we actually saw interest rates drop, which is a net positive for fixed income. Now, while we do think it is highly unlikely that rates do fall once again in 2015, we would caution investors from abandoning bonds altogether in the event that we do have some kind of shock to the financial markets. Europe goes into a deep recession. We could very realistically see foreign dollars aggressively flow into U.S. debt and move interest rates even lower. We did feel that this slide was very interesting from the standpoint of showing the impact of a strong dollar on foreign market returns. So if you focus on the 2 columns on the right, you'll see that had you invested in the local currency of foreign markets, you actually would have experienced a positive return. So you'll see the local developed emerging markets, EFA, which is heavily investing in Europe, at 6.4 in the local currency, but actually negative 4.5 in U.S. dollars. And EM was a similar story. So clearly a strong dollar reduces your impact when you convert from the local currency to U.S. investments. So why did that happen, and why was there such a large dispersion? Well, the Fed ended QE3, which was the asset purchase program, where other central banks were actually implementing aggressive policies to fight off deflation, to stimulate growth. On top of that, it's also widely accepted that the Fed is going to be raising short-term interest rates at some point in 2015, and that expectation is already priced into the currency markets. Crude oil. I think this chart actually says that all of us had another impact on a pretty significant impact on the markets in the 4th quarter. The sudden drop in crude has really been fascinating from our perspective to watch. Why exactly did this happen? Well, OPEC refused to cut supply. We've also had the U.S. shale boom has also added to an excess supply, and then there's also just been a reduction in demand globally that wasn't necessarily forecast, Europe being one of the largest reasons for that decline in demand. So market does not like shocks in any way, shape, or form. Clearly, the sudden drop in oil prices fell into that category. As a result, we saw a sudden spike in volatility in the end of the year with the subsequent plunge in oil prices. And I think there's 2 points that you should take away from all this activity regarding oil and energy, because we're getting this question from clients on a regular basis. Low oil prices is actually a net positive for the U.S. economy. Consider high oil prices act effectively as a tax on the consumer. We are a net importer of oil, so these low prices translate to the pump and lower gas prices, which is generally good news. And then the other point that we believe, to some extent, this has been a self-feeding spiral, which often happens in financial markets, that the prices start to decline, and then you just have this excessive sell-off. And we think to some extent that's happened. We're not going to sit here and pretend we're in the business of forecasting commodity prices, but we do feel that oil is probably oversold, and we'll see a recovery at some point. Whether it's 6 months from now, 9 months, certainly difficult to say. I also wanted to spend a moment on current and fiscal monetary policy, because it does provide some insight into our firm's viewpoints that will be discussed in detail shortly. If you take a look at the chart in the upper left-hand corner, this is unemployment rates showing the the Eurozone and then the U.S. And if you zone in and really focus on 2009 and 2010, that represents the point in time where our Fed got very aggressive, implementing the various forms of quantitative easing, aggressively lowered interest rates to really try and stimulate the economy. And you can see that they were somewhat successful, because unemployment was at a peak of around 10% during the financial crisis. Today, numbers at 5.6. Now, if you look at the numbers for the Eurozone, the European Central Bank has gotten quite a bit of criticism from economists for not being more aggressive in their attempts to to fight off deflation and stimulate growth, when what has happened, as you can see, is unemployment has trended up. Their stock markets have been very, very disappointing, particularly relative to U.S., and they haven't participated in the global recovery. And to take it a step further, if you look at the chart in the bottom left corner, inflation in Europe has been decreasing on an annual basis, to the point now where the primary concern in Europe is fighting off deflation, because deflation is a negative for every market. So they're going to be very, very aggressive to make sure that deflation does not happen. And that transitions to global investing. So is this a risk worth taking today? Because we will absolutely acknowledge that over the course of the last 3 years, returns from international investments have certainly been subpar. But if you take a look at this chart, even with the last 3 years of strong outperformance by U.S. market, a global portfolio has outperformed over that period of time, and it's actually done so with less risk. So this isn't the opinion of OJM Group. This is actually factual research, and if you were to manipulate the years, the periods of time, as long as you have an extended time period, you would see results that are relatively consistent with the numbers that you see in front of you. And today actually feels a lot like the time period from the late 90s and early 2000s. And if you look at the chart on the left, it shows how, the bar graph on the left, it shows how U.S. stocks significantly outperformed international investments. And, personally, I was getting the question, as were my colleagues at this point in time, why wouldn't I just put all my money in the S&P 500? Well, probably the best example of that is what transpired from 02 to 07. So the U.S. market stagnated, and we saw aggressive recoveries in both in Europe as well as in emerging markets. And that's aside from the fact that the S&P, we're not that far away from October of 2007 to March of 2009, where we saw a 55% drop from peak to bottom. So not only from the risk management standpoint, but there's a whole set of opportunities globally that you can invest in. And if you limit yourself to the U.S., you're really missing out on some potential opportunities. However, it's hard for investors to to buy into that, and the natural inclination is to invest in what's done well. Now, keep in mind the market's very, very forward-looking. It's looking out 12 to 18 months. And a perfect example of that is if you look at the bar chart on the bottom here and you look at the returns of the average investor, that number tends to be in that 2 to 3% range, and this is a period of time covering about 20 years. Numerous studies that I've seen conducted by various independent research firms have all continuously confirmed the same info, that the average investor dramatically lags the market because they act on news that they're hearing now, and if you're doing that, you're acting too late. And the reason we bring all this up is because there is such a tendency to abandon international investments, at a time where, the S&P's outperformed by dramatic numbers. So we are of the opinion that that's a mistake. And, as much as we've talked about the benefits of diversification and investing internationally, we're not going to blindly do that. And I think this chart says it all in terms of why, there is an area of the world right now that we're not very, very optimistic. There is certainly a strategic component to this. You can see the debt that Japan is facing right now, in addition to some of the demographic challenges that country's facing. It is an area of the world that we are actually not investing in. So I think that's a good point to make. So the reason that most of you tuned in today was our asset class view and our portfolio positioning. If you paid close attention, you probably got a sense of where we're going to go for 2015, but I felt there was some value in breaking this down by asset class. So if we start with U.S. stocks, we are actually slightly underweight both large and small cap securities relative to what we would call a static portfolio. Now, there's several reasons for that. U.S. stocks are no longer cheap today. A strong dollar can actually put a lot of pressure on profit margins, because you have you have the local producers now that are going to have to meet the costs of the competitors producing goods at a very, very low cost with an expensive currency. You also, our base case scenario for U.S. stocks is single-digit returns. And our expectation is that may very well be the case over the next several years. We will continue to have most of our clients' funds in U.S. stocks. In other words, we will have significant domestic exposure for a variety of reasons. Number one, we're not calling for a recession. We just feel like that international investments offer greater upside over the course of the next several years. And keep in mind, you pay your bills in dollars. You don't pay your expenses in won or rupee or euros. So it's just logical to have the largest portion of your investments in U.S. stocks. If we move to Europe, we do expect outperformance, for a variety of the reasons that we had discussed earlier, oil being one. Europe is a very significant, one of the largest importers of oil, so lower oil prices clearly is a benefit to those economies. We talked about monetary and fiscal policy, how the European Central Bank is starting to look a lot like the Fed did in 2009 and 2010, creating an environment that should be very, very favorable for equities in those countries. Emerging markets, demographic trends support, emerging market stocks. There's a very, young population in most of these countries. On average, they're growing at a rate of 5 to 7% from a GDP perspective. If you put that in context, U.S., the number has been around 2.5% over the course of the last several years. Yet, if you look at the 3-year returns, the emerging markets have seen 15 to 20% of the return of U.S. stocks. So not only do you look from a valuation perspective, but a lack of participation in the in the global recovery, and we just feel like that there is the potential for double-digit returns in emerging market equities over the course of the next 3+ years. Fixed income. Rising rates are very likely that and I think you're going to hear that from most economists, that will put pressure on traditional bonds. So we do expect the Fed to raise rates at some point in mid-year. So we have reduced exposure to traditional bonds, and we have moved into unconstrained bonds, or what some may call go-anywhere bond funds. The characteristics of these type of bonds would be willingness to hedge against rising interest rates, bonds that have shortened their duration, in other words, their average maturity, and also those that the characteristics of these fixed income investments, they do tend to have a slightly more credit risk. That's the trade-off. We don't have a lot of concerns about defaults at this point in time, so we feel like that's a more prudent way to allocate our fixed income investments in 2015. And finally, alternative investments. We do have a healthy allocation to this category. So, the underweight that we have in the traditional fixed income area, and also the underweight in large and small cap U.S. equities have been allocated to alternative investments. Our alternatives are designed to offer returns above traditional bonds, yet have a lower risk profile than traditional equities. We do believe that alternative investments lower volatility of the overall portfolio and do offer the potential for returns of U.S. stocks over the course of the next 3 years plus. So that concludes our market outlook for today. Thank you for tuning in. As I had mentioned in the beginning of the presentation, we would certainly love to offer a copy of our book for doctors only, Fortune Building for Business Owners and Entrepreneurs, and one of the other books referenced in the presentation. We would certainly love for you to sign up for our e-newsletter. Instructions are on the bottom right corner here of the presentation. There's a link to our bookstore. There's a promotional code to get a complimentary copy of one of our books. We're certainly willing to offer a free consultation to the listeners of this webinar, and if you would like more detail, if you are a current client, please contact your current advisor. You can reach out to me directly via the phone number and email listed there, 877-656-4362. We'll reach our office, ataylor@ojmgroup.com. Again, will come to my direct email address. So thank you.